I think what the Fed has done is to promise the market that it will tackle inflation in a very aggressive way. I think it's you know Chair Powell has noted that Fed's communication has been effective, but then they still showed up slightly more hawkish than what the market was expecting before the Fed meeting. So effectively, they're guiding the market that they will do even more. So now we're at a time when the tapering is about to end next month, and then rate hikes start in March, and perhaps quantitative tightening start in the second half of the year. So we need to see one of two things: either inflation come down substantially enough to offer the Fed some more comfort, or the market comes down sufficiently to, to alarm the Fed of financial disorderly financial system. So I don't think at this point neither one of those points have been reached, and that's why I believe we probably will see more shakiness in markets, in the months to come.
For the Asian region, the consensus seems to be that inflationary pressures are not as pressing as in the US, and that we might be in a reasonably stable condition to ride out this period. How do you see things happening here, and what's your strategy?
Sure, I think the Asian markets are I think a little bit better placed, right? Because like you say, inflation is milder. The central bankers are not as nervous as the Fed, and that China is actively easing monetary policy. Markets could be shaky ahead of the holiday, but I think after the holiday, we could see more positive flows. So more recently, we have actually added our asset allocation to Japan and China. And we think, Japan, for example, is the cheapest among the developed markets. It is relatively cheap, below historical average compared to itself. And China, of course, is likely to see the most significant policy easing in both monetary and fiscal sense this year. So I think these two are top picks for the region.